Howdy, Jacob here. Today we're looking at A.O. Smith Corporation in the building products industry, 12.7 billion market cap on slightly lower enterprise value. Been around since 1874. Looks like they manufacture and market residential and commercial gas and electric water heaters, boilers, heat pumps, tanks, and water treatment products globally. The growth has been more impressive than I thought it would. 2.3 billion in 2014 to 3.8 billion in 2023. So not quite doubling, but really outside of COVID years, you're seeing upper single digit growth, which is definitely an impressive feat. And both gross margin and operating margin both increasing, as well as return on invested capital. So those increases in margins and return on invested capital greater than revenue is one of a few possibilities that can occur through showing moat status. And then the balance sheet does show 340 million cash on hand with just 127 million in short-term and long-term debt. So no concern from the balance sheet. Cash flow shows a good increase in cash from operations and capital expenditures about the same. So good growth in free cash flow. Their use of cash seems to be 50 to 60% share repurchases. Their dividend is about 40%, with the remaining 10% or so reinvesting in acquisitions. And they're buying back shares, hopefully at cheap prices. The dividend paying out, or dividend has been growing quite a bit. While they're repurchasing shares, they're able to increase the dividend on a per share basis even more. And I think we can set some assumptions here. I would say that I probably wouldn't be surprised if we saw a 7%, a 6% revenue growth a year over the next 7 years. And then on the PE price to free cash flow side, I mean, it looks like they have some sort of a moat with those types of margins. Operating margin almost 20% and heavily increased. Same with gross margin increasing and ROIC increasing. So I think I'd be comfortable with maybe a 17 P price free cash flow. It's not a super capital intensive business, which we saw from capital expenditures being quite a bit below cash from operations. So I think I feel good about that. And on the margin side, I'll do pretty close to averages here. I do like that free cash flow is higher by quite a bit. So maybe let's do 13 and 14 with 2% buybacks would be about 250 million dollars in aggregate, and that would leave a good amount for dividends, and then 15 to 20% for reinvestment and acquisitions. So I'm good with 2% repurchase. The dividend, let's increase that 7% or so, so it's roughly the same payout ratio. Again, these assumptions are assuming 15 to 20% leftover cash flow to reinvest and make acquisitions when you repurchase 2% a year roughly in dividend. Obviously, these are just assumptions. 2% a year, if the stock price were to double or triple, they would have less capability of being able to purchase 2% of shares, and they shouldn't. They really shouldn't. So this is just assuming, with the current price that we're seeing, with their current dividend, with the current market, what do I think is going to happen? And I think with their capable free cash flow, I'm good with about 45 to 50% going towards share repurchases, 30% to dividend, and then the remaining to acquisitions and reinvestment. And that still gets us to a price that is still, we want to buy it quite a bit lower than what it is today. So great company, and one that I just want to wait till it gets to a more attractive price for, which I don't think it is currently there yet. So hopefully you enjoy the video. Have a great day. Thank you.